Okay. All right. So will you say anything about, okay, I'm just getting my head wrapped around it. Okay, so we'll just start with the questions.
Yep.
You're laughing at me.
No, you're doing good.
Okay. All right, Alexis, what should a lender consider when identifying a market to lend in?
Yeah, this is a great question. If you're a new lender, you have to figure out, where am I going to do business? The main things, there are three main things that you need to consider. The first one is, what market are you familiar with, right? Do you know a certain market more better than you know another market, right? If you live in Orlando, Florida, does it make sense to do deals in Arizona? Do you know that market, or do you know someone in that market who can help you underwrite? As you guys can see by going through the checklist, underwriting is a huge piece of this. You have to figure out what things are worth. So the knowledge of the market is one major thing to take into consideration. The second thing is the foreclosure laws. If you start to do a lot of loans, you do enough business, at one point, someone's going to decide, I can't pay this, I'm defaulting. Someone is going to default on you. So you want to pick a market where the foreclosure laws are in your favor. And so you can determine, do you want to deal with a 6-month foreclosure process? Do you want to deal with a 9-month foreclosure process? Or do you want to deal with a 2-month foreclosure process? But the foreclosure process is gonna change state by state. And so deciding where that is going to be is totally up to you, and a major thing to consider when picking a market. And finally, the usury laws. So how friendly is this state for lenders? How much can you charge a borrower? Is the usury, 10% or 12%? And usury is how much you are legally allowed to charge a borrower. So you want to research the usury laws. You can do that by contacting a title company or an attorney in that state and saying, hey, I'm trying to write up a promissory note. What is the max amount that I can charge a borrower without violating usury? So those are three main things to consider when you're trying to pick a market, identify a market to lend in.
Excellent. Very helpful. Okay, next, what are the biggest risks with lending private money on real estate?
I love it. Biggest risk when lending private money in general is someone not paying you back. Now, that little nuance on real estate, that's why we have the collateral. So if you are not doing your underwriting correctly, that is the biggest risk. If you think the property is worth 150,000 when in reality it's worth 70, that's the biggest risk. So knowing your market, knowing how to underwrite correctly, and lending less than what the property is worth is going to be your best bet to protect yourself. The second thing, biggest risk when lending money on private real estate, is not doing your paperwork correctly. So one main thing, and this is another FAQ, is you need a lien on the property. In some states, this is called a security deed. It's called a deed of trust. In some states, it's called a mortgage. But without a lien on the property, your borrower could pay off the house and they could take all the money, and then they're deciding whether or not to pay you back. A property cannot be sold without the lien being removed if it's going through title and escrow, unless it's something like a sub 2 where someone's taken over that debt and taken over that mortgage. But traditionally, whenever a property is being sold, the title company, the escrow attorney, will reach out to you to remove your lien. So if you don't have the lien, they never know that you're owed money, and they never know to reach out to you. So the first thing, risk, is underwriting, making sure you're figuring out what the property is worth correctly and have that value 100% locked in as the correct number. The second thing is the paperwork, protecting yourself by going through title every single time so that you can have all the correct paperwork done and filed and recorded.
Great. All right, with your experience, Alexis, what are the most prevalent scams you see for private money lenders?
Great question. So a lot of scams that you'll see as a PML is actually not what you think it is. There are borrowers who are completely scamming, but they're typically asking for a loan that doesn't make sense. So once you underwrite it, you can figure that out completely. This doesn't make sense. This property's not worth what they say it's worth. But another scam that you'll see a lot, which you have to be careful of, is title companies and escrow attorneys being scams. So when you receive wiring instructions, it is so essential that you don't just trust, okay, I got sent these wiring instructions, I guess this is where I'm wiring. You want to research that closing attorney, you want to research that company, go on the Secretary of State to see how long they've been open, look at their reviews on Google. we have a rule in our business that if this company's open less than a year, then we're going to send someone out on foot, boots on the ground, to go there and talk to the attorney in person. So you'll see a lot of scams that have to do with the title company. Now, going back to traditionally as a PML, the most common scam that you'll see is someone sending you different pictures than the actual property you're lending on. So this has happened to us. Luckily we don't go through with it because we have our processes in place. But borrowers will send you pictures of a property that looks all dandy and nice, but you're actually lending on a completely different address. So it's essential to go out there yourself, or like I mentioned, get boots on the ground, to go with someone you trust, to go and take pictures or walk and inspect that property with the exact address that you are lending on. That's happened countless times where people will send pictures of a different property, or tell you, hey, this property is nice and rehabbed, and you go there and it's halfway burnt down. So those are the two most prevalent scams to look out for when doing private money lending.
Great. Okay, next one. What things increase risk on a PML deal?
Got it. So the things that increase risk on a PML deal, there are two main things. Number one, if you're lending more than what the property's worth, you're obviously at more risk. If you have a property that you have identified its as-is value is $200,000, and your borrower is asking you for 210, 205, 201, whether it's 250 or 201, you're lending more than what it's worth. And so if you're going to take that risk, you should be rewarded for that risk in terms of your return. More risk, more return. The second thing is increasing risk is getting paid at the end. If you get paid at the end, you are putting the deal in your borrower's hands and counting on them to fulfill and finish your project. All of our deals, because we have a very conservative perspective, are structured with monthly interest payments. However, you'll see you'll see private money lenders. A lot of traditional institutional lenders never do this, but you'll see private money lenders decide, okay, I want to get paid, I will accept to get paid at the end of 3 months or at the end of 6 months, and they'll have a balloon payment. That 100% increases risk, because if something goes wrong, you find out 3 months too late or 6 months too late. Whereas if you get a monthly interest payment, your borrower is motivated to pay you every month. They're motivated to get the project done because they have to pay you every month. And you have an opportunity to check in with them monthly and make sure that the project is going well and is on track. So those are the two things that increase risk: if you're lending more than what it's worth, and number two, how you structure your payments getting paid at the end.
Alexis, do you want to mention anything around like what's on the risk calculator? So like what state people are in, the first position, HUDs, things like that?
Great question. So some other things that could increase risk dramatically is a little bit more subjective, but definitely things to consider, which is the foreclosure laws in that state. It is also the experience of the borrower. For example, if you're lending someone money in Hawaii who's never done a flip in Hawaii, that's going to be a more risky deal than if you're lending money to a fix and flipper in the market that and they've done hundreds of flips before just like it. So those are things that also will increase risk on a PML deal.
What are the biggest issues to look for when vetting a borrower?
Great question. So I think this is covered really, really well in the checklist. When vetting a borrower, you want to get their HUDs, you want to see their past projects, and if they're a fix and flipper, you need their buy and sell HUDs. You need to see what they bought it for, and you need to see what they sold it for, because it takes 2 transactions for them to make money. The biggest issues to look out for when vetting a borrower, you want to make sure that they don't have any bankruptcies. And if they have experience in the past, I would always ask, how did you finance your properties before? And if they have lenders that did that financing before, I would call those lenders and call them and see if it was a hassle to work with that borrower. It is not uncommon for a new lender to get a letter from the previous lender signed saying, hey, there was no missed payments, this borrower was never late or never defaulted. So those are things to look out for, that they don't have any bankruptcies, and that also their previous ways of financing properties are still giving them the thumbs up, and they haven't had any issues before.
Can you speak to how people look up to see if a borrower has a bankruptcy and if they're current in on their previous, like the first lien position loan? Yeah.
So the way to figure out if they're current on their previous loan, you have to talk to the borrower. It's not public record if they're current, if they were current or late with their previous lender. You have to. You can also. That's why we need HUDs. You can look at the HUDs and see who is the past lender and get in touch with them, or the borrower can connect you and you can get some sort of proof from that lender that they are the principal of that company. But in terms of the bankruptcy, you can do that via background check. We can add on here like, hey, here's how you can conduct a background check on your borrower. But again, all of these things are really, really important when you're lending more than what a property is worth. If you're lending less than what a property is worth, the property is your main collateral. Vetting a borrower becomes extremely important, like the checklist says, when you go in second position or third or higher. When you're in first and you're just looking at the property, you don't have to be super concerned about a lot of this stuff, but it's always good to get the information needed from the borrower and making sure that they don't have any issues with previous lenders or with bankruptcies in the past.
Great. So let's talk about security instruments for a little bit. So can you explain what a promissory note is and what it does?
Yes. A promissory note is a document that states what are the terms of the deal. It is an IOU piece of paper. So the promissory note will outline how much you loaned, when is it due back, what are the payments due to you, when are the payments due, when is a payment late. It'll outline all the terms of the deal. It can outline what are the late fees, when the payment's late. And so the promissory note can have anything in it. You could require that your borrower show up to your house and do 3 cartwheels on the first of every month. And if they don't do that, they are in default of the loan. Now, I hope you wouldn't add something that silly, but you can add whatever you want in the promissory note. And that is the piece of paper which guides the loan and is the guiding factor on whether or not the borrower is in default or if they're in agreement with the way that the loan was structured.
How about a security deed?
Okay, perfect. So a security deed is the instrument that liens against the property. This puts a lien against the property. So a security deed does not have the terms of the deal. It only states how much you loaned and the exact amount that you're owed back. And that will be a lien against the property. So if you loan $250,000, they will file a lien against the property owed to you for $250,000. It's very important to have both, because if you have a promissory note without a security deed, you have a piece of paper, which is great, and you'll have to sue in order to foreclose and get that money back, which, depending on which state you're in, could be very low probability that you actually end up being able to. If you have a security deed without a promissory note, if you try to foreclose with that, your borrower could argue that they aren't in default, that they haven't violated the terms of the deal. So you need both promissory note and security deed in order to protect yourself when it comes to paperwork. A security deed is also called a deed of trust or mortgage in some states, and the reason that's important is because it puts a lien on the property, and traditionally a property cannot be sold unless the lien has been paid off or cleared. So it clouds title, and it makes the title company, whoever the person is closing the next transaction, have to reach out to you in order to pay you off for the next sale to take place.
Great. Very helpful. Other security instruments. So what is a lender's insurance policy?
Great question. A lender's insurance policy is something that the title company or closing attorney can issue you, and that's a charge that the borrower pays. But this is basically insuring you as the lender in case anything was ever missed and anything was wrong with title. For example, if they said, hey, your loan is in first position, we're insuring that, and the borrower goes to sell the property and all of a sudden a new first position comes up, that title company will insure your capital because they insured that you were in first position in the first transaction. If you do not get title insurance, little mishaps like that can make you automatically be pushed to second. So it's super important to get a lender's insurance policy to make sure that you are protected as a lender if anything's missed at title, if someone signed for the owner that's really not the owner, if you thought you were in first but you're really in second. Like, if the title company will insure that, then you are protected if anything's missed or anything is mistaken at the closing attorney's office.
So this is the title company that provides this, is that right?
100%.
Okay. All right, next one, what is property or home insurance?
Yeah, so home insurance is really, really important. I think a lot of people miss this last document here, but you need your borrower to get home insurance on the property, because if the property floods, if it catches on fire and burns down, if a tornado comes and takes it away, you need to make sure that you're protected as the lender. So you have to require your borrower to get home insurance and have you listed as the mortgagee or loss payee, so that if anything happens to the property, the insurance company is paying you out what you're owed on that loan.
What to do if someone doesn't pay? So if a borrower defaults.
Yeah, so like I mentioned, if you do enough loans, it'll eventually happen. Someone will default on you. What you're gonna do after that is really up to you. I can tell you what we do. We typically will, communicate with them and figure out what they can pay right now. So if someone owes us $5,000, we'll say, look, if you can't pay us the whole thing, pay us 2,500, pay us three, pay us two, and as long as they're willing to pay something, we have good faith that they're gonna complete and fulfill what they have due. People get in hard spots, and so we're private money lenders. We're not institutions, so we don't typically foreclose and say that's it and right away. If we're willing to work with people, so if they can pay us something and show us that they have good intentions, then great, we'll work with them and they'll eventually catch up. If they completely ghost us, or they say, look, I just don't have it, they're even talking to us, but they say, look, I just don't have anything, then we'll start the foreclosure process right away. There's no need, absolutely no need to waste time if you know, either if you know, number one, for sure that you're not gonna get paid, or if someone's completely ghosting you and not responsive. If someone's completely ghosting you, you should start the foreclosure process right away. And if someone just says, look, I wish I could, but I just don't have it, I would start the foreclosure process right away. But if they're willing to put something up towards their payment, or show some form of good faith, then we will typically work with them. Again, what you choose to do is completely up to you, but that's how we treat it in our business.
For you and Abraham, how often does that happen? Like, to set a private money lender's expectation,
Mhm.
how common is it for there to be situations where a lender would need to work with a borrower to extend? Um,
Yeah, I
they
think
get behind. Yeah.
Yeah, it really depends on who you're lending money to. So fortunately, in our business, we have relationships with these people. They have a history of paying on time, so it happens very little. If you're working with someone who it could be their fifth or sixth flip and they're tight on capital, it could happen a lot if that's your target borrower. But if you want to avoid this happening, one thing that you could do in the beginning before you decide to do a loan is ask that person for bank statements showing some amount of money that they're able to afford the monthly payment that they're signing up for. Because you can prevent that in the beginning. If someone can't show you a bank statement for 20 grand and your monthly payment is three, it could be a really tight deal. If they have some random expense like rehab or anything, they could be falling behind very easily.
Great. How can you confirm the security deed has been filed with the county?
I love it. So a security deed needs to be filed, or else it's worthless. It's almost worthless. If you have a signed security deed but it's not recorded, that means that the lien hasn't been filed. And how liens work, whoever's first is in first position. So the first person to file the lien is in first position, the second is second. So if you don't file the lien, your borrower could get other debt and then push you back into a different position. This is why it's so important to work through a closing attorney or title company, because they will confirm with you. The way to confirm is to confirm with whoever you're going through to do your documentation that they have filed and recorded the security deed. Another way that you could check, every single county has a different website, but typically a county has a website or a courthouse that you can go to and check what liens are filed against a property. That's going to be specific to the state and specific to the county. But the main way that we utilize is going through the title company or the closing attorney and confirming that they have recorded it. And once they've recorded it, you can get a copy of those recorded documents. They'll have a stamp, usually in the left top corner, saying when it was recorded, the exact time and date, and you can see that on the recorded docs.
How long does it typically take the title company to record? So once
Yeah.
they record, when can you confirm it?
Same day. If they're closing, they should be recording on the same day of closing, not more than 48 hours, 2 business days after that. If they're waiting to record, then that's an issue with that title company or closing attorney. If they have not been instructed to wait and they're waiting, then you have a big issue with that title company or closing attorney.
The lender, if you go out to confirm on the county website, how long would it take from the time they, what's the question?
Record.
Yeah, record for it to show up that you can confirm it. Yeah.
Well,
Should I
that's
ask
gonna
that
depend
again?
on that's gonna depend on how fast the county can update their records. But I would say, within 2 business days, if you don't see it, it's definitely appropriate to start asking questions.
Okay. All right. How should a lender disperse funds for a rehab?
Love it. So if you are lending on rehab specifically, some people will lend on purchase, some people will lend on rehab, some people do both. But whenever you're lending on a rehab project, someone needs an extra 50 grand to finish your rehab, you should always be lending in draws. So what that means is it's little increments of capital rather than the full amount. So if someone needs 50 grand, I'm going to say, great, I can lend you the 50 grand, but I'm not going to give it to you all at once. Go and do $5,000 worth of work, and then I'll give you $5,000. Then you can do the next $5,000 worth of work, and I give you the next $5,000. The reason this is important is if the deal's tight and there's not a lot of equity, you need the house to be worth more in order to lend more, right? If the as-is value is here and the loan to value, the debt on it is here, you cannot loan more money. You cannot put more debt on a house that's not worth more. So you ask them to go and complete more rehab, then you lend more money. Complete more rehab, then you lend more money, and so on. So you should always, if you're doing a rehab loan and there's not tons of equity to just deploy, you should always lend rehab in draws.
I think that also helps because you then will understand right away if the rehab is running late, right? If it's taking
100%.
them longer than they expected, then you'll be notified right away.
100%. And also, you need, as a lender, if you are lending on rehab, you need to go out and inspect and confirm that $5,000 worth of work has been done. And every time you go out, you can charge a $50 inspection fee, $100 inspection fee for your time. Or maybe you don't go out yourself. Maybe you're at a beach with your feet kicked up because you decide to be a lender, right? And you hire an inspector to go out. And that inspector charges you $25, you charge the borrower $100, right? So every time, if you are lending on rehab, you need to inspect to make sure that rehab has been done. Because again, people will send you fake photos of a rehab that is not actually the property you're lending on.
Okay, next question. If loaning in second position, how can a lender find out the first position information and if they're current? You
Great
spoke
question.
a little bit to that earlier.
Yeah. So the main way, if someone's asking you for a second position loan, they should 110% be willing to share their first position loan contact information. If they're not, that's already a huge, huge red flag. You shouldn't have to go chase down this information on your own. Your borrower should be willing to give you the contact info of their first position loan. And so we talked about promissory notes. You can put in your promissory note that your borrower is required to show you proof of payment to the first position lender on the first of every month, or else they're in default of your second position loan. So number one, contact the borrower, collect the first position information, and you can reach out to them and say, hey, is this borrower current? Have you had any issues? Like, obviously you don't want to call them every month and make sure they paid. That's why I encourage you, if you're doing seconds, thirds, fourths, whatever, you require that in your promissory note, if they do not show proof of payment to the positions before you, then they're in automatic default of your loan. Because it's really, really dangerous if you're in second and the first position's gone in default and now they have late fees and their own missed payments. You easily get pushed out of, equity that you may have thought you had.
Right. We talked about inspections associated with renovation. So another question, when should a lender get an appraisal or inspection of the property?
Great question. So if you were thinking about getting an appraisal or inspection of the property, number one, you should get an appraisal if you don't know the market. You can get an appraisal, you can ask a realtor, you can ask wholesalers, but if you're really not familiar with the market and you're lending in a place that you have no idea what things are worth, it's worth it to get an appraisal because someone who's local is going to tell you exactly what that property is worth, who's more familiar with that market and that area. An inspection you need to get also before you do the loan, confirming that the property that you are lending on is the same one that you got sent photos on, etc. and you can make sure that there's nothing that's missing in the photos. If you're a borrower and there's one room with a hole in the wall, you could send 50 photos, but you keep out that hole in the wall. So an inspection and in-person walkthrough allows you to see things that maybe they omitted from the photos as well. Both of those you need to get. If you're not, an inspection for sure, no matter what, an appraisal if you're not sure about what you're lending on. Both of those you should get before you decide to lend the money and do the wire.
Great. Next question. What should the lender charge for late fees? What's standard or typical, Alexis?
Yeah, I love that. So there's actually no standard for late fees. Late fees depend on what market you're in. They depend on the usury laws of the market you're in. For example, in Georgia, usury is 60%, so we don't charge more than a 5% late fee, right? So again, this is a question that you can charge whatever you feel comfortable with, but I would also encourage you to ask whoever's the closing attorney or the title company writing up your promissory note, what am I allowed to charge? If you want to charge $5,000 on a late fee, in some states that's considered unreasonable. In some states it's completely legal. So you have to figure out what's kind of worth it for you and what you're comfortable with, and then you have to confirm that it's legal in that state that you're doing the loan in.
Can you take us through the foreclosure process?
Sure. So we mentioned if you do enough loans, you will get foreclosed on. No, excuse me. We mentioned if you do enough loans, you will have to start the foreclosure process. So let's talk about it. What is the foreclosure process? A lot of people have a misconception that the foreclosure process is them now owning the property. It's not. The foreclosure process is the process of this property going to auction. So if you are a lender and your borrower has defaulted, you then will start the foreclosure process. From start to auction, it's going to depend on what state you're in. But at auction, investors are typically bidding on that property to then buy it for themselves. So you'll give the county or whoever's handling the auction a payoff amount. Here's everything I'm due. My principal, my late fees, all my missed payments, my attorney costs, my pain in the ass fee. Here's everything that I'm due. Here's what you should start the bid at. And so they'll start the bid and people will either bid each other up, or maybe no one bids on the property, but it's the process of auctioning it off. You actually don't ever own the property unless no one bids on it. If no one bids on it, then the deed is sent to you and you own that property and you have to figure out what to do with it from there. But the typical foreclosure process, it will go to auction, someone will bid on it, you'll get paid off, and they will be the new owner of that property.
Great. Final question that has come up. How do you determine the as-is value of land?
Love it. So you determine the as-is value of land by getting an expert in land, right? If you don't know anything about land, you cannot loan on it. Again, do not ever loan on things that you don't know what they're worth. It is the number one way to lose money. If you don't know what something's worth, you just can't loan on it. So if you're trying to determine the as-is value of land, you have to be very careful, because if you're looking at a lot, the lot next door could have sold for 70 grand, but your lot has swamp or concrete or mud under it, and that lot next door was like a solid one to build on. So you have to be very careful. You want to get inspections done, but most importantly, if you don't know, if you're not a land expert, I would always recommend getting in contact with someone who is. Contacting a realtor, appraiser, or a wholesaler, investor who does land, so that they can tell you exactly what they think it's worth. And the main question that I ask when I'm trying to determine the as-is value of something, if I don't know it, I'll go to a wholesaler, a realtor, another investor, etc., and I'll ask them, what could you blow this out for? Like, if you had to sell it today, what could you for sure sell it for? People, like, anyone would buy it for that price. And that's what I'll take as the as-is value. And I'll go as far as I can up on that price, but that's what I'll take as the as-is value, because we know for sure we can get rid of it for that price.
Right? Are there any other questions that you get a lot that we haven't covered today, that are not covered in that checklist?
Not about loans. Those are all the main ones.
Okay. Great.
Awesome. That's perfect.
You think that'll work okay?
That will work great.
Great. So I was